Assalamualaikum and hi everyone, my name is ASYIKIN binti Rahiman. My matric number is 1190811 from TME3. Inshallah for today's presentation, I'm going to present about my article and review and summary that I choose, whereby it's about credit scoring, probabilities and pitfalls by Cynthia A. Glassman and Howard M. Ruskin. Without any further ado, let's start. Okay, as for introduction, the concept of credit scoring is originated in academia as have many business applications. Therefore, the credit scoring was introduced and developed due to the availabilities of technology and accessible of database. They are applied in predictive statistical models or bankruptcy prediction models to determine credit decision for a lender in predicting the likelihood of repayment in individual credits. Over the past year, a surge in interest regarding credit scoring model has been driven primarily by two requirements of lending institutions, which are the first one emphasize on increased efficiency in the processing of application and in making loans, and the second one is a desire to manage risk by creating consistent and fair methods for offering credit. Therefore, credit scoring is a cost-effective credit management tool. However, it is important to understand that the potential pitfalls of credit scoring in order to maximize its benefits and minimize its risks. Next, we go to the second part, which is about how the credit scoring model works. Okay, the credit scoring model works by using the potential debtor's credit history information that combined with other data regarding the potential debtor's ability to repay the loan. For example, the credit history information that used in these methods or models are the credit history, current income, investment or asset level, home ownership, job stability, education level, debt to equity ratio and current credit outstanding. Then the model then attempts to predict the potential debtors' likelihood of default based on prior experience with debtors of a similar profile. Depending on the model, most will result whether accept or reject judgment, and this method also will determine whether the lender decide whether to make the loan and how to price it the financing to the debtor. Okay. Next, we go to the benefits of these credit scoring models. Credit scoring models benefit both lenders and customers. There are 5 benefits which are okay. The first benefit of credit scoring model is increase with efficiency and reduce time. The use of credit scoring tends to reduce time for lenders in determining the debtors' worthiness, and it also reduce time on the labor time and response time in the application process by allowing immediate handling of the definite yes or no decisions, leaving credit officer available to focus on the borderline credit that are less well handled by the models. And in addition, the application process that used to take weeks are reduced to days or hours. And the second benefit is reduce potential for bias. By instituting a standard process for grading an applicant's risk, banks should reduce the possibility of unfair lending practice. And the third one, ability to target specific risk segment by targeting a large number of borrowers in higher risk loan segment, whereby the bank can better price and reserve risk. And the fourth benefit of credit scoring is learning system, because it is capable of self-learning over time by regularly estimating the model with a larger base of data. And the last benefit is it simplifies securitization because it's easier to rate credit for the purpose of bundling and securitizations. Next, While the benefits of credit scoring are fairly well known, the danger of using these tools also should not be ignored. There are 5 pitfalls of credit scoring, which are: the first one of pitfalls or shortcomings of credit scoring model is GIGO, which means garbage in, garbage out. Due to these models are extremely complex and based on statistical analysis, the probability of inaccurate credit report information, such as the inaccurate database of historical loan behavior, can invalidate the credit score result. The second one is seasoning is important because due to the fact that credit score model based on the historical repayment data, they tend to give an accurate result due to the time frame and business cycles. And the third one is dealing with atypical potential debtor, which means the system misdiagnose the potential debtors result, whereby it can lead to a probability for lenders to miss highly qualified applicants being denied credit due to inconsistencies in credit profile or unusual employment history. The fourth one is privacy, whereby the financial institution must take strong steps to ensure the security of their system and to have appropriate practice and policy to protect their customer information, such as the sensitive information like income, employment history, and information from being open for the public. Otherwise, improper security and practice of the data could lead to a significant effect for the bank. And the last one is unintended bias or fairness, whereby in this model tend to have unintended bias toward those who lack credit history but have a good record in paying their commitments like expenses, like for example the rent expenses and utilities expenses. And also this model also bias against women who on average have shorter credit history than men. Okay, as for the conclusion, what I can conclude that these scoring models do not decide the desired risk level of the portfolio. That decision is made by the financial institution in determining the scoring levels and decision points within the models, as the risk decision is the bank responsibilities to make. In addition, credit scoring models can be an excellent tool in determining the potential debtor's creditworthiness. However, this model also have their shortcomings in dealing with human element. This is because the model are still not able to look at a customer behavior precisely. Therefore, credit scoring can provide huge advantage to both financial institution and its customer, as long as the model is used properly within the framework of an overall credit management system. Lastly, I would like to say about my comment regarding to this architect, that this architect is very interesting and well informed with the outputs, as I gain lots of knowledge and benefit after reading. However, I would like to suggest or to give some feedback regarding to this article, whereby the author should put some input regarding to the information of the types of credit scoring models that have been implemented by financial institutions nowadays for further knowledge. Overall, this article still good as it gives lot benefits to me and the readers. I think that's all from me and for my presentation. Thank you for listening and watching my video. Thank you and Assalamualaikum everyone. Bye bye.